First of all, talk to you about why equity investors hate this news so much.
Well, I think the real issue here is the global economy. So even though the last 3 weeks we've been focused first on Europe and then, of course, the US, and that's achieved a lot of airplay, but the problem is that the real issue has been the slowdown in the global economy. When you look at the business condition indicators in Europe, the PMIs, they've been falling very sharply. Even Germany this time has been falling quite sharply, unlike middle of last year when we last had those concerns about a double dip. And likewise, when you look at the US, the ISM index has fallen to only just above 50. Personal consumption, personal income figures are very weak. And so I think the real issue is that these worries about debts have just distracted from the slowdown in global growth that's occurring. If anything, they've probably made business conditions and business sentiment and consumer sentiment more negative than would otherwise have been the case. And I think that's really what's worrying investors right here, right now.
Shane, but we don't have really signs of much of a slowdown taking place in the Asia-Pacific, do we? I mean, it does seem like the third leg of the world economy is still bearing up quite nicely.
That's right, and I think that's partly why the Asia-Pacific index, if you look at, say, the Morgan Stanley Asia ex-Japan index, it hasn't come down nearly as much as, say, the US share market, which is back to its March lows, or in fact below its March lows, and the European share markets, the Euro stocks, for example, which has gone well below the March lows. So Asian shares have held up reasonably well, and I think that reflects the somewhat better economic outlook and the better stats coming out of Asia compared to the rest of the world. The problem for Asia, of course, is if Europe and the US do continue to slide away and growth continue to weaken, then it will have an impact on Asian exports and obviously on confidence, and that, of course, is why Asian markets are off today in line with markets in Europe and the US.
Well, it's sadly predictable, but once we've got this debt deal in the US, well, we've moved very nicely into now talking about Italy and Spain once again, with bond yields there going over 6%.
That's right. It seems someone described this whole issue as like a game parlour game called Whack the Mole, where this mole keeps popping up and you've got to press a button to try and whack the latest mole off. And that's effectively what's happening here. It's happening in Europe. You know, one moment it's Greece, and then of course it's Portugal and Ireland, and now it's back to Italy and Spain, which do look quite worrying. And of course over the last week it's been the US on the debt front. But quite clearly the package of measures that the Europeans put together 2 weeks ago now haven't been enough to do the trick. The EFSF, the Financial Stability Facility, is not big enough, and there's worries, I think, that Italy and Spain can even make their contributions to that fund. Consequently, given all of those things, and this worry that investors themselves will be forced to help bail out maybe Italy and Spain in future problems, has pushed up bond yields in that part of the world. So Italian bond yields up to a new Euro period high, and Spanish bond yields up to the level where they were a few weeks ago. So that's obviously an increasing concern. I reckon if it was a year ago and Germany was looking a lot stronger like it was a year ago, then you wouldn't be as worried about it. But you'd have to say it is a major concern right now.
Well, the Reserve Bank there in Australia is also concerned, isn't it, Shane? I mean, we didn't see a move when it came to interest rates. We've got trade data today, but they're monitoring it carefully, aren't they? And what are the concerns there for Australia?
Well, I think the Reserve Bank has been surprised by the weakness in domestic demand in Australia. So, yes, we've got the mining boom coming through loud and clear, massive boost to national income from high export prices, and, of course, we've had upside surprises on inflation. Flip side, though, is that domestic demand outside the mining sector, particularly household-related demand, has been far weaker than expected. And that weakness has lingered well beyond the impact of the floods early this year. And on top of that, the global backdrop, which the Reserve Bank assumed where we'd get growth just above trend, is also proving to be much more uncertain. So consequently, I think the Reserve Bank was right to leave interest rates on hold. My view is that we're probably going to see another few more months where rates are going to remain on hold, probably into early next year. Then it's 50-50 as to whether the next move is a rate cut or a rate down. But I must admit I'm starting to lean towards the view that the next move may actually be a rate cut in Australia, just the way the news domestically and internationally is going.
Well, one of the things that we've seen with, of course, the debates on debt taking place in Europe and indeed the US is that we've seen currency appreciation in Asia. When does that start to hurt Asian economies themselves?
Well, I guess any rise in a currency will start to have some negative impact. I think, though, when you look at the Asian currencies, they're still a long way from the point where it causes severe pain. Most Asian currencies are still somewhat undervalued on a purchasing power parity basis. Therefore, given the relative strength of Asia compared to the relative weakness of Europe and the US, there's probably more potential to go on the upside. But I reckon that Asian central banks and authorities will probably do their best to make sure that it remains a gradual pace of appreciation, therefore trying to limit the pain for exporters, particularly when export demand globally is starting to slow down again.